Voxtur reported Q3 numbers. So in this video, we're going to go through the numbers and see if they're good. What do they mean? So what you have in front of you is from Cedar Q3 numbers here. And then I'm going to minimize it here to compare it to the prior quarter, which is Q2. So we're going to first look at the revenues. So you can see the revenues were 35.5 million, and in the prior quarter they were 38 million. So it's about down 6%, right? So now, is this good or bad? Well, of course you don't want the revenues to be going down, but we do know that it's a horrible real estate transactions, right? So I'm not terribly surprised that they're down. But if you look at some competitors in the space, they were absolutely destroyed on revenues, right? Because they are more, their business model is more tied to the transactions, and it's not as resilient as Voxtur's revenue. But still, Voxtur's revenue are down about 6%. Now, so that's on the negative side. On the positive side, if you look at gross profit in the Q2 was 12.6 million, and now it is 13.5 million. So gross profit is up while the revenues are down 6%. So how is that possible? Well, because of the expansion in gross profit margin. So gross profit margin in the prior quarter was 33%, and gross profit margin in Q3 was 38%, right? So that's good. That's good. Now, I'm just going to quickly jump first all the way to the bottom line, because it looks like net loss for the period is only 1.7 million, and in the prior quarter it was 4.1 million. So you can be like, yeah, congratulating that the net loss was significantly reduced, right? But then if you start digging a little bit more into the numbers, you might realize that, hey, this is not actually as good as it looks. And then you dig a little bit more and you realize, hey, it's actually good. So here's what I mean. First, if you want to depress yourself first, then what you do is you go from the gross profit of 13.5 million, and then you go into operating expenses, technology and operations, selling and business development, and general and administrative. You see that they are 23.3 million, and you can see the loss from operations of 9.7 million, right? Where the same loss from operations in the prior quarter was almost 12 million. So the loss from operations is better, but still like, oh my goodness, they almost lost $10 million, right? So then how do we get to a small loss of only 1.7? Well, you go to other income and you can see that the other income, 1.6 million was added, changing contingent consideration, and then a big one that was added was foreign exchange gain, right, of 6.4 million. So, and then we had an income tax recovery of 2 million, and so that's how we ended up only with such a small loss. So then you can be like, well, it's terrible because foreign exchange gain obviously is not something that is repeatable, right? It's not recurring. So it's like, oh, they're going to continue losing this money, right? And that's why in our case, we have to look at adjusted EBITDA to see whether their business is actually trending towards profitability or not. Because you see, in these expenses here, general and administrative expenses, there's a lot of expenses in it that, number one, are non-cash, probably like amortization, and also expenses related that are non-recurring, like related to the acquisition. They've been working on that Blue Water and acquisition for a long time. And if you look at the press releases, you can see here they closed the Blue Water acquisition on September 22nd, right? So in other words, they got only 1 week of revenue from Blue Water acquisition, but the expenses, the lawyers and all that stuff, working on the acquisition was, included in the quarter, right? But we didn't get the revenue, right? So those non-recurring one-time expenses like this are most likely included in it. And that's why I want to go and look at the adjusted EBITDA, which here starts off with that small loss of 1.8 million. And then you can see here that the amortization of intangible assets, they added back about 4 million because it's a non-cash expense. And then that change in contingent consideration that I was showing you was subtracted. It was again back there, now was subtracted. Impairment loss was added here. That income tax recovery that we got the benefit of on the income statement, now it was subtracted here, but that foreign exchange loss that we got a positive benefit from it now was subtracted here. But these costs related to non-operating items, non-recurring items, they were about $3 million. So that those two expenses here, $3 million here, and then 4 million here of amortization, that's about $7 million. $7 million of extra expenses that show on the income statement, and then they show, the loss from operations was so big because this 7 million was included in it, and three of it is not really recurring, right? And 4 of it is not really cash outlay, right? So that's why they do this. And then the adjusted EBITDA, which is in the press release, is only $1.4 million. So this quarter, even though the revenues declined by only 6% in this horrible market, the adjusted EBITDA was almost positive. And then it was much better than the prior quarter, because the prior quarter was $4 million and this quarter only 1.4, which makes me think that if the revenues didn't decline by 6%, they would have probably been adjusted EBITDA positive this quarter, which again, it shows that the business is getting better and better, the margins got better, and they are moving closer to profitability, right? Now let's look at the balance sheet. On the balance sheet, they show $12 million of cash. They have trade receivables of 17, and then trade receivables due to related parties of 13.5 million. I believe that this is a receivable owed by Jim Albertelli's law firm. So I'm going to wait for the conference call to see how it's going to be addressed, because, of course, the repayment of this would, hugely put, the cash balance of Voxtur, at over $20 million. Another thing that I would like to be addressed is what showed up in the current liabilities. As you can see, current portion of long-term debt now shows at 61 million. Before, it was only 6.5 million. So anytime you see something in the in the current liabilities sections, that means that if you don't know anything about this current debt, it's like, oh, it has to be repaid within 12 months. That's the basic rules of accounting. But I think it has something to do with probably, again, covenants getting tricked or something. And then as a result of this, it has to be reported in the current section of the current liabilities. And based on what I was reading already, there was just a small amount that it was tricked by. And it happened before. So I think this has to be addressed. So that's a negative. It doesn't concern me because it's been an issue before, and they have the backing of BMO, and then those covenants get reinstated, and then the debt moves to the long-term portion. So anyway, so overall, you can say two negatives are that revenues declined 6%. You can view it as a negative because it's a negative 6%. You can view it as a positive if you want because everybody else got absolutely destroyed in this market. So you can say, well, only 6% is fantastic, but I'll just keep it as negative for here. The positive is that the gross profit improved because of the margin expansion. So that's positive. Another positive is that they're moving closer to profitability. The adjusted EBITDA, when you subtract the non-cash items and non-recurring items related to things that are not part of the business operations, the adjusted EBITDA was only negative 1.4, which is almost profitable based on EBITDA basis. And then the second negative was, of course, the current portion of long-term debt that showed up in current liabilities. So hopefully those two things can be addressed. And so let me know your thoughts. What did you think about the quarter? Am I correct here? Or do you have any other thoughts that you might want to share? Thanks for watching.